There are about 44 million surgeries performed in the United States every year. Of those, roughly a third are theoretically eligible for robotic assistance. Right now, fewer than 1 in 5 of those eligible procedures are actually done with a robot. That gap, the distance between what's possible and what's actually happening inside operating rooms across the country and around the world, is the entire investment thesis for one stock. That stock reported last Monday, and the earnings were not close. Non-GAAP EPS of $2.50 against a consensus of $2.12, a beat of 17.9% on the bottom line. Revenue of $2.77 billion against an estimate of $2.62 billion. The fourth consecutive quarter of major outperformance.
And the stock is still down 25% from its 52-week high. That's the tension you're looking at with Intuitive Surgical. The business keeps beating, the valuation keeps making people nervous, and the question of which force wins in the end is one of the most interesting debates in all of healthcare investing right now.
Welcome to Charged Alpha. I'm Hudson Thomas here with Lana Chen. Today we're breaking down Intuitive Surgical, ticker ISRG, the maker of the Da Vinci robotic surgical system, the most dominant franchise in medical robotics. 4 consecutive beats, a Citigroup upgrade, and a stock that's still searching for its floor after a brutal year. Let's dig in. Intuitive Surgical was founded in 1995, not by doctors, but by engineers. The core insight was that if you could translate a surgeon's hand movements into precise robotic micro-movements at the tip of a surgical instrument inside a patient's body, you could make surgeries safer, faster, and more consistent. The company went public in 2000 and spent the better part of the next decade installing the first-generation Da Vinci systems in major academic medical centers. Today, it is headquartered in Sunnyvale, California, employs roughly 15,000 people, and is one of the most valuable medical device companies in the world, with a market cap of $160 billion.
The business model is what makes this company unique. Intuitive operates on a razor and blade structure that would make any investor smile. Hospitals buy the Da Vinci system, a capital equipment purchase that runs somewhere between $1 and $2 million depending on the configuration, and then every single procedure performed on that system requires Intuitive's proprietary instruments and accessories. Those instruments are single-use, they cannot be reused, and they are priced at around $2,000 per procedure. Every time a Da Vinci system does a prostatectomy, a hysterectomy, a colorectal resection, Intuitive gets paid. On top of the instruments, there are multi-year service contracts for system maintenance. The result is a recurring revenue stream tied to procedure volume that compounds with every new system placed.
The installed base now exceeds 9,500 systems across more than 70 countries. The newest platform, the Da Vinci 5, launched in early 2024, and is driving a major upgrade cycle at existing hospital accounts. The company also makes the Ion endoluminal system, a separate robotic platform for minimally invasive lung biopsies that gives Intuitive a beachhead in diagnostic pulmonology.
The why now for Q1 2026 is straightforward and striking. Revenue grew 22.9% year over year. Non-GAAP EPS came in at $2.50 against $2.12 estimated, for a beat of 17.9%. That is the fourth consecutive quarter where Intuitive beat estimates by double digits. The Da Vinci 5 is not just ramping, it appears to be ramping faster than even the optimists expected.
Intuitive Surgical's CEO is David Rosa, and his story inside this company matters for understanding the transition this business is in. Rosa joined Intuitive in 2012 and spent his early years building out the commercial organization. He became president and chief operating officer in 2019, and then CEO in 2023, succeeding Gary Guthart. Guthart had been CEO since 2010, a co-founder who guided this company from $100 million in revenue to the multi-billion-dollar franchise it is today.
What's notable about Rosa's background is that he is a commercial and operational leader, not a scientist or engineer. At a company that is now in the middle of the most significant product launch in its history, the Da Vinci 5, that orientation matters. Managing a global installed base upgrade cycle, hospital sales relationships, manufacturing at scale, and clinical education programs across dozens of countries is fundamentally a commercial and operational challenge. The early evidence says Rosa is executing well. 4 consecutive beats on both the top and bottom line under his watch are not a coincidence.
The transition from Guthart to Rosa also raised questions about whether the deep institutional relationships that Guthart built with hospital systems and academic medical centers over 2 decades would hold. So far, the procedure volume numbers say yes. Those relationships are intact, and in many cases deepening as hospitals complete their Da Vinci 5 training programs and ramp procedure counts on the new platform.
Let me take you through the Q1 to 2026 financial picture. Intuitive Surgical trades at $451.29 per share, with a market cap of about $160.3 billion. The trailing price-to-earnings ratio is 53.8 times, a number that will make value investors flinch. But the more relevant number heading into earnings season is the forward PE of 44 times on 2026 consensus estimates. That's still premium, but it's closer to what the historical average has been for this franchise.
What does the PS ratio look like?
Price to sales is 15.1 times on a trailing 12-month revenue base of approximately $10.6 billion. That is a premium multiple that reflects the market pricing in continued 20+% revenue growth and 66% gross margins. The EV to EBITDA is approximately 40.5 times, and price to book is 9.1 times on a book value per share of $49.58.
Take us through the income statement.
Q1 2026 revenue was $2,770.8 million. That's against a consensus estimate of $2,618 million. Revenue grew 22.9% year over year from $2,253 million in Q1 2025. Gross profit was $1,830 million for a gross margin of 66.1%. Operating income was $855 million for an operating margin of 30.9%. Net income was $821 million. The GAAP diluted EPS was $2.31. The non-GAAP adjusted EPS, the number analysts estimate against, was $2.50 versus the $2.12 estimate for that 17.9% beat.
And the balance sheet?
Exceptionally clean. Total assets are $20.1 billion. Cash and short-term investments are $7.98 billion, essentially $8 billion in cash on hand. Total debt is zero. The company has zero long-term debt. Net debt position is negative $7.98 billion, meaning cash exceeds all obligations by roughly $8 billion. The current ratio is 17.4 times. Free cash flow on a trailing 12-month basis through Q4 to 2025 was approximately $2.5 billion. Overall, Intuitive Surgical's financial health is strong. $8 billion in cash, zero debt, 66% gross margins, and free cash flow generation that funds the entire Da Vinci 5 build-out without touching the balance sheet. The only watch point is the valuation premium, which leaves zero room for execution errors.
Analyst sentiment on Intuitive Surgical is broadly constructive. 28 analysts cover the stock, 18 have buy ratings, 9 are at hold, and just 1 has a sell. The average price target is approximately $540, representing upside of about 20% from the current price. The range runs from $450 at the low end to $660 at the high end.
The most interesting call heading into the Q1 print was Citigroup. They upgraded Intuitive Surgical from neutral to buy on April 21st, the same day as the earnings release, citing the Da Vinci 5 ramp and underappreciated procedure volume acceleration as catalysts for multiple expansion. Goldman Sachs maintained their buy rating post-earnings, noting that the 17.9% beat reflects structural volume gains rather than one-time items. BTIG maintained buy, pointing specifically to international procedure growth running ahead of domestic, which they called a multi-year, underpenetrated market opportunity. Truist held at buy, calling the Da Vinci 5 upgrade cycle a durable margin driver through 2027.
And the cautious voices?
Mizuho maintained neutral, flagging the 44 times forward earnings multiple as a ceiling on near-term upside despite the strong fundamentals. UBS also held at neutral ahead of earnings, cautious on valuation. The neutral thesis is not that the business is broken. It's that the stock is priced for all good outcomes already, and any friction in J&J's Ottawa launch timeline or hospital capital spending could trigger rapid multiple compression.
Let me make the bull case for Intuitive Surgical. First, the procedure penetration gap. Less than 20% of surgeries globally that are eligible for robotic assistance have converted. That gap is enormous, and every year it closes through installed base growth, trained surgeon expansion, and new clinical evidence. It generates more instrument revenue without requiring a single additional system sale. Second, the Da Vinci 5 upgrade cycle. The existing installed base of 9,500 systems has barely started converting to the 5th-generation platform, which commands higher average selling prices and opens new procedure categories including advanced visualization and haptic feedback applications. Third, international expansion. The United States is roughly half of Intuitive's revenue. Countries like Japan, Germany, India, and Brazil have dramatically lower robotic penetration and are now in the early stages of hospital system build-outs. Fourth, the systematic beat and raise pattern. 4 consecutive quarters of outperformance averaging over 15% is not noise. It signals that procedure volume is compounding faster than sell-side models can track in real time. And fifth, the capital position. $8 billion in cash, 0 debt, and $2.5 billion in annual free cash flow. Intuitive can fund the Da Vinci 5 global rollout, pursue acquisitions, and buy back shares simultaneously.
Now the bear case, and it deserves a serious hearing. First, Johnson & Johnson's Ottawa robotics system. J&J has one of the largest hospital sales forces in the world, deep existing relationships with surgeons and procurement teams, and is building Ottawa specifically to compete with Da Vinci on soft tissue surgery, the heart of Intuitive's franchise. When Ottawa launches commercially in the U.S., the monopoly pricing dynamics that have sustained 66% gross margins come under pressure for the first time. Second, valuation. At 44 times forward earnings and 15 times revenue, one soft quarter could take 20 to 30% off this stock, even if the long-term thesis is intact. Third, Medtronic's Hugo system is commercially approved in Europe and gaining traction in urology, historically one of Da Vinci's strongest indications. European hospitals are now using Hugo as competitive leverage against Intuitive in instrument pricing negotiations. Fourth, China risk. Geopolitical tensions and domestic Chinese robotic surgery platforms are creating headwinds in what has been a significant growth market. Fifth, the stock is already down 25% from its 52-week high of $603. That sell-off tells you the market is already wrestling with the valuation question. It has not resolved cleanly.
How does Intuitive Surgical compare to peers? And for a medical device company with a razor and blade model, PS is a useful lens because it reflects the revenue quality and growth premium the market assigns to the franchise.
Intuitive at 15.1 times revenue is in a league of its own within medical devices. Stryker, which also has a robotic surgery system called Mako for orthopedic procedures, trades at approximately 3.8 times revenue. That is a 65% discount to ISRG on a price-to-sales basis. Stryker is a high-quality company growing at double digits, and the market does not give it remotely the same multiple. Medtronic, which is in soft tissue robotic surgery with Hugo, trades at roughly 2.4 times revenue, a reflection of its slower growth profile and broader device mix. Edwards Lifesciences, another premium medtech franchise with dominant positioning in transcatheter heart valves, trades at about 8 times revenue, despite having higher gross margins than ISRG. That comparison is interesting. Edwards has 78% gross margins versus 66% for ISRG, yet ISRG commands nearly double the PS multiple. The difference is growth rate and the procedure flywheel.
So the premium is explicit and intentional.
Completely. The market is paying for the combination of monopoly positioning in a large, addressable market, 66% gross margins, and a compounding flywheel that grows instrument revenue without additional capital expenditure. The question is whether that premium is still justified at 44 times forward earnings with a competitor on the horizon.
On the options side, we don't have specific put-call ratio or implied volatility data for this episode. What we can tell you is that Intuitive Surgical carries a beta of 1.679. The market treats this as a high-volatility healthcare stock, consistent with its growth premium and valuation sensitivity.
The stock's position relative to its moving averages is notable. At 451, it's trading below both the 50-day moving average of 479 and the 200-day average of 502. That positioning, combined with the 17.9% EPS beat, likely set up an interesting options dynamic. Put buyers heading into the print were expecting the worst-case valuation scenario, and the actual result was significantly better. The post-earnings options skew probably compressed meaningfully after the print. Key strikes to watch going into Q2: the 450 put support level and the 500 call resistance. A close above 500 on sustained volume would be a technical confirmation that the floor is in.
On insider activity, detailed transaction data wasn't available from our source for this episode. What we know is that Intuitive Surgical executives and board members routinely sell shares through pre-scheduled 10b5-1 trading plans, standard practice for insiders with large restricted stock vesting positions. No unusual insider buying or selling was reported around the Q1 2026 earnings print.
The company focuses its capital returns on share buybacks rather than dividends. Zero dividend, approximately $500 million in annual share repurchases. CEO David Rosa and the management team have structural incentives aligned with long-term holder value through equity compensation. The absence of open market insider purchases in a stock that's down 25% from its high is worth noting. Management is not signaling a screaming buy, but they are not selling at unusual rates either.
The key risks for Intuitive Surgical going forward. Number 1, competitive entry from Johnson & Johnson's Ottava system. This is the most significant structural risk to ISRG's monopoly pricing. When it launches in the US, it will be the first credible soft tissue robotic competitor in the American market. The timing is uncertain but likely within 12 to 18 months. This is the binary event that the stock market is pricing most carefully.
Number 2 is valuation compression risk at 44 times forward earnings. Any single quarter of below consensus procedure growth could drop 20 to 30% off the stock price, even if the fundamental business is healthy. Number 3 is China market risk. Domestic robotic surgery platforms and geopolitical friction are headwinds in what has been a meaningful growth contributor. Number 4 is hospital capital budget sensitivity. Da Vinci system placements are capital purchases that can be deferred in periods of hospital financial stress. And number 5 is the Da Vinci execution risk. Managing a global installed base upgrade from older platforms to the new generation requires precise inventory and deployment management. Watch for any signs of slowing placement rates or customer delays.
And the single number that matters most.
Procedure volume growth rate reported quarterly. It tells you whether the flywheel is accelerating or slowing. System placements matter, but procedure growth is the leading indicator of future instrument and service revenue. Also watch for Da Vinci 5 as a percentage of total new placements, which signals whether the upgrade cycle is on track.
So what's the bottom line on Intuitive Surgical? Q1 2026 was a statement quarter. Non-GAAP EPS of $2.50 against $2.12 estimated. 17.9% above consensus. Revenue of $2.77 billion against $2.62 billion estimated. Revenue grew 22.9% year over year, and this is the fourth consecutive quarter of double-digit earnings outperformance. The procedure flywheel is not slowing. The Da Vinci 5 upgrade cycle is contributing. International markets are growing ahead of domestic.
The tension is the valuation. At 44 times forward earnings and 15 times revenue, you are paying a significant premium for everything to go right. And the competitive landscape is about to change for the first time in more than a decade. J&J's Ottava is coming. Medtronic's Hugo is taking share in Europe. The monopoly that sustained 30% operating margins is going to be tested. The question is not whether Intuitive is a good business. It clearly is. The question is whether the premium it currently commands is justified as the competitive moat gets its first real test. The key metric to watch: procedure volume growth each quarter. If it stays above 15% year over year, the bull case remains intact. If it decelerates to single digits, the multiple comes down fast.
We'll leave you with a line from Gary Guthart, the co-founder who built this franchise over 3 decades. He once said, "The power of robotics is not that it replaces surgeons, it is that it makes the impossible possible." That's the thesis in 2 sentences. The surgeries that were too risky to attempt, too deep, too delicate, too close to critical structures, are now achievable on a Da Vinci platform. David Rosa is now running that mission. And 4 consecutive earnings beats say the impossible is becoming routine.
The bet is that the addressable market is far larger than anyone has modeled, and that the 18 months before J&J's Ottava launches give Intuitive enough installed base runway to defend its franchise. Whether that bet pays off at 44 times forward earnings is the question every ISRG investor is asking right now.
That's going to do it for this episode of Charged Alpha, your deep dive into Intuitive Surgical, ticker ISRG. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh, we do! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.